Jeff, we did a video recently where we highlighted a stock that's on your watch list right now, and that's Dutch Brothers. We're going to take a little different approach right now. We're going to talk about Dutch Brothers as a stock to buy, but a stock that I've been generally bullish on, Starbucks. I know I sometimes I have blind spots. I think we all do with stocks, but I think we should make the bear case on Starbucks, both of us, and then go over why you think Dutch Brothers is worth buying right now. What do you say?
Yeah, sounds good. Let's do it.
Before we do, though, in addition to these great stock conversations we're going to have right now around Starbucks and Dutch Bros, we have a great partner with these videos, our sponsor, The Motley Fool. And The Motley Fool has a great offer for you. Go to our link. You see it on the screen, fool.com/unscripted. Go to that link. The Motley Fool is going to give you its 10 best stocks to buy right now. Be sure to check that out. Again, fool.com/unscripted. It's on your screen, people. You can do this. I believe in you. All right, Jeff, you ready to start with the bear case for Starbucks?
Let's do it.
All right, let's start with this. Price follows sentiment. You look at the two lines on the screen. One is a very bullish sentiment. This is over the past year. One is a very bearish sentiment. And of course, the kind of purple blue line there. Would you call that cobalt? Can we call that cobalt?
Yeah, I was gonna go with purple, but sure, you can call it whatever you want.
Yeah, we'll go with purple. That's better. That's Starbucks. It's been a pretty bad year, and Dutch Bros stock is after what looked like a great IPO and then a big losing streak for the stock after. Dutch Bros stock has really come back. And what's happened, in short, don't want to talk about Dutch Bros. We'll focus right now on Starbucks. Is the company is say maybe they've run out of caffeine. Sorry, Jeff. I know.
You should apologize to all of our viewers for saying that.
I will unapologetically pull up this slide to prove my point. Revenue for Starbucks. Starbucks has about 200 more locations open than they did a year ago, yet revenue was down 1% for the year. You look at China, the much hyped, most important market for the company is expected to be in a number of years its largest, most profitable business, passing the US. Comps fell 11% there. A ton of that fall was lower traffic. We saw lower traffic in the US as well. Now, contrast that, I'm not going to talk much about it, but contrast that, Jeff, you'll talk about it, with what's going on at Dutch Bros. It's a much smaller business, just located in the US at this point. Business is booming, comps are up. There are signs that the Starbucks growth story is starting to weaken.
Yeah, and time will tell whether this is a bump in the road or the beginning of a trend. Just in the last few years that I've been keeping an eye on Starbucks, I used to own it, I don't anymore. This is not uncommon to see a period or two occasionally where things trend in the wrong direction. I think the challenge with Starbucks is they're an enormous company. They are ubiquitous, not even just in this country, but they have a presence all around the world. And by their own admission, they are pinning their future growth on China, which I think is a pretty risky move considering the geopolitical threat that exists there, how quickly that market can turn against you. We saw it happen during COVID, which hopefully is a once in a lifetime event. We don't have another pandemic. That whole shut everything down indefinitely decision eventually became something that was contrary to what the rest of the world was doing. And yet they were doing their own thing. And it's just the kind of place where you're at the whims of what the government wants to do. And I think that's risky. And that seems to be where they're pinning a lot of their growth hopes. So I'm bearish on their future from that standpoint, I would say primarily.
Yeah, and I think that's fair. There is certainly risk there, but I'll counter that a little bit with India is becoming an emerging market where the company is starting to get some really good traction. India's middle class is growing, economic opportunity happening there, is creating a larger middle class, people with disposable income that are looking for great places to go and things to spend their money on, including caffeinated beverages. So I think the risk there is a little bit tempered with some opportunity around the world. And then I'll say this too. We've seen Starbucks go through these periods before where business got weak, traffic slowed down for a period, but customers eventually came back. The growth returned. They're the largest coffee buyer in the world. They have immense cost advantages as a buyer of coffee that gives them a big advantage. And they proved that they have pricing power as well with consumers to some degree. Here's my last bearish point on Starbucks. This is probably the biggest thing to me that has me really thinking about maybe not selling right now, but certainly not adding any more capital and giving them time to prove things. And that is the idea of the marginal customer. They reported really big growth with their Starbucks Rewards customer. They have hundreds of millions of dollars in cash sitting on their balance sheet because of people putting money on their Starbucks Rewards account that they're just waiting to use. even with the growth of that, we still saw that 3% comps decline in the US. To me, that's a sign that the marginal customers are finding other places to go. And this is where we pivot to talking about one of the companies that looks like it's getting those marginal customers in droves.
Yeah. Oh, I want to just add on to that really quickly. One of the things I wonder about with
Jeff, I
Starbucks,
set up the perfect
you
segue.
did. It was a beautiful segue, and I will get there. But I do think what you said is worth adding on to, which is I wonder about their pricing power and I wonder about the margin profile in some of these newer and emerging markets, right?
Yeah.
Just as a Starbucks customer over the past, I'll just say 5 years, have absolutely noticed how much more drinks cost than they used to. And I think that's a lever they can pull here and they can probably pull in some other international markets. I don't know if it's a lever they can pull as much in every single international market. So, yes, there could be growth in other countries like maybe India. I just don't know if it's going to be the same margin profile when they expand there. But all right, so let's go back to your beautiful segue and talk about Dutch Bros. So it's a little bit of an apples to oranges comparison in the sense that I believe Dutch Bros has less than 700 total locations as opposed to the 40,000.
38,951 at the
Right.
end of its
So
last quarter.
a little bit of
Yeah.
a different ballgame there. And anytime you're growing off a smaller base,
Starbucks has more locations in Topeka than Dutch Bros has everywhere. Not
right.
really, but
Yeah,
but
look, Starbucks is ubiquitous. It's hard to go anywhere without seeing multiple Starbucks. And as a comparison, Dutch Bros is in only 17 states. So if you live in 2/3 of the country, you've probably never seen one or been to one. So you might not even know what the company is until you watch this video. But they are putting up pretty impressive growth in a couple different ways. Revenue growth is pretty impressive. Shop growth is impressive. I'm going to share a slide here. So these four graphs sum up how things are going. So on the top left, you see the shop growth, 2% year over year. That's about where they've been for the past 3 years. That's pretty impressive. Revenue growth it's been growing in the 20 to 40% range. It was 39% in the most recent quarter. The contribution margin, which is the bottom left graph, that's important for the company. So they target 30% contribution margin for any new shop to hit within 2 years. And basically,
that contribution margin, this is their restaurant, their shop level, store level,
yeah, it's
gross
basically
margin.
operating. It's basically, you can think of it as
Yeah, more or
operating
less, because
margin.
it's the store level margin and they add in depreciation and amortization for each location as well.
Now, I'm going to be fair. The bottom right graph is a little bit deceiving. It shows that their net income and their adjusted EBITDA are going up pretty nicely. Their adjusted EBITDA is very adjusted. So I'm going to ignore that. It takes out a lot of expenses. And there's not a clean number for GAAP earnings right now because they have some non-controlling interest. We don't need to go into that. I would summarize their profitability as being around break even over the average of the last couple of years. But here's where I want to focus. Because their locations, once they come online, get up to the same gross margin and profitability level as the company as a whole fairly quickly, it does feel like that this 20-25% year over year store growth is sustainable for them. They're going to burn cash because you need capital expenditures to open a new location. So they're going to stay free cash flow negative for a while. If they can keep this profile going while they grow, or maybe even improve it, then you could see them maybe being able to up their store count to maybe 30% a year or 35% a year and just really hit the gas pedal there. And to me, that's the more exciting business between the two, right? It's almost like, now I'm not saying Dutch Bros will be Starbucks. That's not fair. It's almost like being able to grab shares of Starbucks back when they were 2 or 3 years into their IPO or something like that. They're a young company with a fast growing brand that seems to be doing well. So right now, I'm more interested in putting my cash in a smaller business that has the growth potential at a good margin profile, in my opinion, than Starbucks, which might be hitting a tougher patch over the next couple of years.